My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
The Federal Reserve says they're fighting inflation. They say they are committed to a 2% target and that they're well positioned to wait and see. But the charts tell a very different story. While everyone is distracted by the quarter-point rate cut and the drama of the dissenting votes, we're staring down the barrel of a massive liquidity injection in 2026 that could send crypto and other assets parabolic. It's a phenomenon that some macro analysts are calling the everything code. And if you understand how it works, you realize that the Fed doesn't actually have a choice. They have to print. So in this video, we're going to explain exactly what happened at the FOMC yesterday, the massive wall of debt that is about to hit the US Treasury, and why 2026 could be the year of the liquidity flood. My name is Guy, and you're watching The Coin Bureau. First up though, I must make one thing clear, I am not a financial advisor. I'm just a chap on the internet reading the tea leaves of the financial elite, so you don't have to. This is educational content meant to show you why the money printer might be dusting itself off for a comeback tour. If that sounds interesting, or indeed terrifying, hit that like button and let's get into it. So, what actually happened at yesterday's FOMC meeting? Well, on the 10th of December, the Federal Reserve cut interest rates by 25 basis points, bringing the federal funds rate to a range of 3.5% to 3.75%. Now, on the surface, that sounds like business as usual. It's the third rate cut this year. But if you pull back the curtain a little bit, this meeting was anything but normal. We saw a historic division within the committee as 3 members voted against the cut. And that's the most dissenting voices we've seen since September 2019. And it wasn't just them. 4 other non-voting participants registered soft dissents. Basically, half the room didn't want to do this. Why? Because inflation is sticky. Core PCE is hovering around 2.8%, well above their target. So, Fed Chair Jerome Powell came out and gave what the market is calling a hawkish cut. He warned that future cuts will be tougher to justify and that they are, quote, well positioned to wait. Now, Powell is talking tough because he wants history to remember him as the guy who beat inflation before his tenure as chair ends next year. But here's the kicker. The market doesn't believe him. Traders are pricing in a 68% chance of 2 or more cuts next year. Why? Well, because of who is likely coming next. Jerome Powell's term ends in May 2026, and right now, the front runner to replace him is Kevin Hassett. According to prediction markets, Hassett has a 72% chance of taking the hot seat, and he's what you might call an inflation dove. He's publicly stated that if he were at the helm, he would be cutting rates aggressively right now. He's even argued for rates well below 3%. Now, this creates a shadow chair scenario. Even if Powell wants to hold the line, the market is looking past him to a successor who seems perfectly willing to turn the liquidity taps back on to please the administration. But
it's not about politics.
There's a much bigger, much scarier reason why the Fed might be forced to pivot, regardless of who sits in the chair. Yes, we need to talk about the debt refinancing wall. So, the US government has a problem, a $9.2 trillion problem. That's the amount of US Treasury debt maturing in 2025 and is roughly 1/3 of all outstanding marketable debt. And in 2026, up to another $9 trillion comes due. Here's the maths that keeps Treasury Secretary Scott Bessent awake at night. You see, a lot of this debt was issued years ago when interest rates were near zero. Now it has to be refinanced, and at rates that are double or triple what they were before. And this is already hurting. In 2025, the US spent $970 billion on interest payments alone. For 2026, that's projected to top $1 trillion. To put that into perspective, the US is spending more on servicing the debt than it spends on the entire defense budget. This is the fiscal dominance trap. If rates stay high, the interest payments explode, the deficit widens, and the government has to borrow even more just to pay the interest. It's a death spiral. And the only way out lower rates. Whether inflation is beaten or not, the Treasury cannot afford to refinance around $18 trillion of debt at 5%. Something has to break. And this brings us to the Everything Code. Now, this chart is arguably the most important chart in crypto, and you'll likely have seen enough of it to last you a lifetime by now. It shows the correlation between global M2 money supply, that is, the amount of cash sloshing around the world economy, and the price of Bitcoin. Historically, Bitcoin moves with global liquidity. In fact, it has a 0.94 correlation with global liquidity over the long term. It is the most sensitive asset to monetary expansion. When the money supply goes up, Bitcoin goes up. When the money supply contracts, Bitcoin struggles. And right now, the liquidity cycle is turning. China is already aggressively easing. They've injected roughly $1.5 trillion equivalent over the last 6 months to prop up their economy. Global M2 is currently sitting at around $96 trillion. And despite the Fed's tough talk, US M2 is growing at 4.6% year over year. The Everything Code suggests that we are entering a period of synchronized global easing. Central banks around the world are cutting rates. The US Treasury is quietly injecting liquidity through buybacks. And Bitcoin? Bitcoin is just waiting for the flood. Now, before we get into the terrifying prospect of yield curve control and what this means for your portfolio, I want to share something that could help you maximize your returns when this liquidity finally hits. If you're looking to position yourself for this potential liquidity cycle, you're going to need a reliable exchange. And you might as well get some bonuses while you're at it. This is where the Coin Bureau Deals page comes in, because this is where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges in the industry. To get these offers, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. These deals won't be around forever though, so take advantage of them while you can using the link in the description below or the QR code on your screen. Okay, now back to the nightmare scenario for the dollar. We talked about the debt wall. But what happens if the market refuses to buy US debt at lower rates? What if bond vigilantes demand higher yields because they see the inflation risk? Well, enter yield curve control, or YCC. This is the nuclear option. This is where the Fed effectively says we will buy unlimited amounts of government debt to keep interest rates low. We saw this in Japan. They pegged their 10-year yield near zero for years. It kept borrowing costs low, but it absolutely crushed the yen. And historically, the US has done this too, back in the 1940s to fund World War II. If the Fed is forced to cap yields to prevent the US government from defaulting on its interest payments, that is effectively restarting quantitative easing, or QE. That is money printing on steroids. Now, they might not call it QE, they might call it market functioning purchases or balance sheet stabilization. But make no mistake, it is liquidity. And there's one final piece of the puzzle, the election year effect. We know that governments love to spend money, but they really love to spend money around elections. Historical data shows that primary deficits rise significantly during election years. We're coming off the back of the great election year of 2024 and heading into the midterms in 2026. The fiscal tap is open. The deficit is running at nearly $2 trillion a year, and that money has to come from somewhere. So, let's put it all together. We have a Federal Reserve that's trying to talk tough but is internally divided and about to be led by a dove. We have a debt refinancing wall of up to $18 trillion hitting in the next 24 months. We have global M2 money supply already expanding, led by China. And we have a fiscal situation that effectively demands lower interest rates to avoid a sovereign debt crisis. So, what's the verdict? Well, the macro setup for 2026 is looking like a perfect storm for liquidity assets. The Fed says they're fighting inflation, but the Everything Code, the reality of the debt and the money supply, suggests that they will be forced to print. Remember though, there is a lag. Bitcoin typically reacts to liquidity changes with a delay of about 2 to 3 months. With global liquidity picking up now and the debt wall looming in 2026, we could be staring at the start of a massive run. But here's the reality check. This doesn't mean number go up in a straight line. If inflation spikes again because of this liquidity, we could see volatility like never before. The Fed might try to slam on the brakes one last time before the dam breaks. However, if you believe that the government will choose inflation over default, and history suggests they always do, then the long-term trajectory for scarce assets like Bitcoin is pretty clear. The liquidity is coming. You just need to be patient. But what do you think? Is the Fed about to lose control of the bond market? Or will Powell somehow manage a soft landing while refinancing $18 trillion in debt? Let me know your thoughts in the comments below. And if you want to understand more about how the global liquidity cycle actually works, then check out the video right over here. That's it for now though. As always, thank you so much for watching and I'll see you next time. This is Guy, signing off.